Am I audible clearly?
Yes,
Yes,
ma'am.
ma'am.
Yes, ma'am.
Yes, ma'am.
Operating income approach is given by David Durand, again the same person who wrote the net income approach. Net operating income approach is opposite to the net income approach. Whatever he said in the income approach, opposite of that he is telling in this theory. In the net income approach, he said that capital structure is relevant to the valuation of the firm. That means if you change the capital structure, if you borrow more and more, increase the debt, the value of the firm will increase. So that is how he also proved it by doing the problems. But his theory was entirely based on assumptions. So he came up with another theory which is opposite of net income approach. This is also based on assumptions, but here he considers the total income of the firm and he says that the shareholders will value the firm as a whole and not as only debt or equity separately. So he is trying to say in net operating income approach, we will not use interest and net income to find the market value of debt and market value of equity, but we'll use the entire EBIT to find the value of the firm. So he has given a different set of formulas for that. So according to NOI approach, the value of firm is independent of its capital structure. That means whatever you do with debt equity, nothing will happen to the value of the firm, is what he is trying to say here. Capital structure is irrelevant to the valuation of the firm. Any change in leverage will not lead to any change in total value of the firm and the market price of the shares, as well as the weighted average or overall cost of capital will also not change. So if you borrow more or less, it doesn't matter. How much ever you borrow, your value of the firm will remain same. Your weighted average cost of capital will remain same. That's what he's trying to prove. So let's go through his assumptions. The very first assumption is the investor sees the firm as a whole and thus capitalize the total earnings of the firm to find the value of the firm as a whole. So investor says that the firm cannot be divided into debt equity. We have to take it as one single entire unit and we will take EBIT to find the total value of the firm. The overall cost of capital is constant, depends upon the business risk, which also is assumed to be unchanged. So here your weighted average cost of capital will be constant. It is not going to change with the change in borrowings. The cost of debt is also constant. The cost of debt is also not going to change. It's going to remain the same. There are no taxes. This assumption was removed later again. And with tax also, he has given the formula. And the last one is very important. He says that the cost of equity will increase. The use of more and more debt in the capital structure will increase the risk of the shareholders and thus result in increase in the cost of equity capital. In my last class also, I gave you this example. Suppose you all are my shareholders and I'm borrowing 5 lakh rupees. You have a certain risk, you will stay with me. But if I double my borrowings and make it 10 lakh rupees, you will say the risk is high, so we want high returns. That means I have to pay you more dividends. So if I borrow more and more, cost of equity will increase because equity shareholders will start feeling risky and they will start demanding for more returns. So these were the assumptions of net operating income approach. Now through his prepositions, he is trying to give the formulas. Preposition is nothing but the formulas and how his theory has come up. So we will see it one after the other. Net operating income approach is based on the following prepositions. The first one, overall cost of capital or capitalization rate is constant. So here he is trying to say the weighted average cost of capital is constant. This approach argues that the overall capitalization rate of the firm remains constant for all degrees of leverage. The value of the firm given the level of EBIT is determined by the formula is given there, V is equals to EBIT upon K naught. Now, are you all there listening?
Yes,
Yes,
ma'am.
ma'am.
Yes, ma'am.
Yes, ma'am.
In the basic assumptions we had seen, they had told EBIT will be constant. And now here he is telling weighted average cost of capital will be constant. Okay, so just look at this formula. Value is equals to EBIT upon K naught. Okay, now if both will be constant, can anybody tell me what will happen to the value? See, EBIT, suppose I say is 10 rupees. It will remain 10. It is constant. Okay, weighted average cost of capital, if I say is 5%, it will remain 5% only. It is constant. It is not going to change if you borrow more or less or you don't borrow. It doesn't matter. EBIT is constant. It will not change. Fixed. Weighted average is fixed. It will not change. It is constant. So what will happen to the value of the firm? Okay, let me take it other way. Suppose EBIT is 100 rupees and cost of debt is 10%. Sorry, overall cost of capital is 10%. So 100 divided by 0.1. How much is the value? It is 1000 rupees. Is that okay? 100 rupees EBIT, weighted average cost of capital 10%. If I do 100 divided by 0.1, my value is 1000 rupees. Now I borrow more. Suppose in this case I had borrowed 1 lakh, I borrowed 2 lakh. When I borrow 2 lakh, EBIT will be still same 100. Weighted average cost of capital will be still same 10%. So what will happen to the value of the firm? Will it be same 1000 rupees or it will change?
It will change, ma'am.
Why it will change? EBIT is 100.
Same.
Same. It will be same. Suppose from 2 lakh I borrow 3 lakh. My EBIT is still 100 and my weighted average cost is 10%. So again 100 divided by 0.1. What will happen to my value?
Same, ma'am.
So even if I'm borrowing more and more, value is not changing because to find value, the things that I'm using are constant. My numerator is also constant. My denominator is also constant. When these two values are fixed, they are not going to change. That means the value of the firm will also not change. Agree? So if I borrow 1 lakh or 2 lakh or 5 lakh or I borrow 0 rupees, doesn't matter. Value is not changing because EBIT and weighted average cost are constant. So this is how he proves that whatever you do with the capital structure, value of the firm will not change. So capital structure is irrelevant to the value of the firm. Understood? In the previous theory, net income approach, what he did was, as he borrowed more and more, the value increased. So he says, more and more if you borrow, the value of the firm will increase. It will change. So net income approach says capital structure is relevant. But net operating income approach, he is proving that it is irrelevant. Whatever you do with the debt, value of the firm will be constant. Okay. Now, how to EBIT is earning before interest and tax. K naught is overall cost of capital. Now I told you that all the theories first assume that there are no taxes, but later they removed that assumption. So if you remove that assumption and you consider taxes, his formula will change. So his formula will be value is equals to, if you see here, they're taking tax rate into account. Value is equals to EBIT 1 minus tax rate plus BT divided by KE. Here T is the tax rate and B is the value of debt. You can also call it as DT. That means debt and tax rate. The split of the capitalization between debt and equity is therefore not significant. So whether you borrow debt or equity, doesn't matter. It is not significant because in both the formulas, if you see, we are taking EBIT. I'm not taking interest or net income. I'm taking full profit. So whether there is interest or no, net income or no, it doesn't matter. The firm is valued using the full profit. So that's why he says we should see the firm as a whole and we have to take the profit as a whole. Any doubts in the first preposition on how to find the value? There are two formulas. One is without tax and the other is with tax. Is that clear?
Yes, ma'am.
Let's go to the next preposition. So in the next preposition, any doubts? Okay. He says residual value of equity. The value of equity is the residual value which is determined by deducting the total value of debt from the total value of the firm. So what is he trying to say here is, when you want to find the value of equity, you have to take the remainder or the residual. Why we have to take the remainder or residual? Because when we earn profit, we first pay interest, and then if anything remains, we give dividend. The same logic is applied here. You find the total value of the firm. After you get the total value of the firm, from that you minus the value of debt. Whatever remains is the value of equity. Okay, so that's why he's telling residual value of equity, because whatever is remaining, we are giving it to equity. So to find the value of equity S, the formula is value minus value of debt. So value of the firm minus value of the debt. So it is S is equals to V minus B. If we don't want to use the term S and B, we can say equity E is equals to V minus D. That means equity is equals to value minus debt. So this is how he'll find the value of equity. The next, change in the cost of equity capital. Why is the equity capital cost changing? And I have explained this earlier also. The more you borrow, the increase in the proportion of debt in the capital structure will increase the financial risk of the ordinary shareholders. And if the risk increases, they will demand for higher rate of return on their investment. Therefore, the increase in equity capitalization rate would match in the increase in debt equity ratio. So the more you borrow, the more will be the cost of equity, because the risk is increasing and the shareholders want more and more money. So this was his third proposition, where he is telling why cost of equity is increasing. Because we are borrowing more, we are increasing the risk. So shareholders are demanding more money, and therefore the cost of equity is increasing. How to find the cost of equity if it is not given in the question? So these are the two formulas. We can either use the first or the second one. When we do the sums, we'll see what the formulas mean. The next is the cost of debt. Now, what is he trying to say using cost of debt? Here he says the cost of debt has two parts, the explicit cost and the implicit cost, which is also called as hidden cost. Now, what is the explicit cost? Explicit cost is the cost which you can see. The interest that you're paying is explicit. You can see it. So if I say I'm taking loan from a bank at 15% interest, that 15% interest is explicit because it is known to everybody. I have to pay it to the bank, and I am recording it in my books of accounts that I paid so much amount as interest on debt. So it is explicit. What is implicit and hidden cost? Because we are borrowing more and more, the cost of equity is increasing. Why it is increasing? The reason is debt. When you borrow more, the cost of equity will increase. So they say increase in that cost of equity is the reason for increase in debt. So you shouldn't consider it as cost of equity, but you can consider it as hidden cost of debt. Instead of directly increasing the cost of debt, they are leading the cost of equity to increase. Are you understanding the logic?
Yes, ma'am.
Basically, what I mean to say is why the cost of equity is increasing because of debt. So we shouldn't say that cost of equity is increasing. We should say that because debt is increasing, the reason is debt. So increase in cost of equity is hidden cost of debt. We cannot see it. We call it as equity because we are paying dividend. But why we are paying more dividend? Because of debt. So they say consider that increase in cost of equity as hidden cost of debt. This is an important question from exam point of view also. I've seen many times the question on explain the difference between explicit cost and implicit cost of debt. So for 3 marks it may come, you should be writing that explicit is something that is, we can see it is a rate of interest which is paid and recorded in the books of accounts. Whereas implicit cost is because of increase in cost of equity due to increase in debt. So this was the next proposition. Now, what does he talk about? Optimum capital structure. In case of net income approach, what we saw was optimum capital structure is if the value of the firm increases and the weighted average cost of capital decreases, that capital structure is termed as optimum. So minimizing the cost and maximizing the value. Agree? All of you remember that? In case of net operating income approach, he is trying to say that As the total value of the firm is not affected by capital structure, whether you borrow, you don't borrow, doesn't matter, the value doesn't change. So he says, no matter whatever the degree of leverage it is or how much ever you are borrowing, the total value will remain constant. The market price of the share will also not change with the change in the debt equity ratio. There is nothing such as optimum capital structure. Any capital is optimum according to NOI approach. So he says you cannot say that this structure or that structure is optimum because the capital structure is not affecting the value of the firm. So you borrow 10 lakh debt or you borrow 5 lakh debt, doesn't matter. Both are not going to affect the value of the firm. Therefore, you can say all the capital structures are optimum. Okay, so he is trying to say any capital structure is optimum according to NOI. Why I am stressing on it so much? Because when they do NOI approach sums, sometimes they will ask you, according to you, which company has optimum capital structure using NOI approach. So you will have to say both the companies have optimum capital structure because according to NOI, all the capital structures are optimum. Is that fine? So let's see the graph. He is trying to say cost of debt will be constant, weighted average cost will be constant, but the cost of equity will increase because of increase in debt. And the reason I have told you many times, when you borrow more and more, risk increases, and when risk increases, the cost of equity will tend to increase. So this was about net operating income approach. In the next session, we'll do Modigliani-Miller approach. Now let's solve a few sums on net operating income approach to understand it practically. We'll just copy down the formulas so that we can use it when we are solving the sums. The first formula is for value of the firm. If tax is not given, we'll use this formula, and if tax is given, we'll use the below formula. Here it is divided by KE. So this was about value of the firm. Then value of equity. The next formula is for value of equity. You can write it like this, or in the way we write, equity E is equals to value of the firm minus value of debt. So E is equity, D is debt. We can use either of it, S and B or E and D. The next formula is to find cost of equity. So these are the two formulas to find cost of equity. Again, here B and S is nothing but B is debt and S is equity. So these are the three formulas which we will be using in the net operating income approach. First is the value of the firm, the second value of equity, and the third is the cost of equity. Okay. Now here there is one sum in net income approach, that is sixth problem, which I have not done, which you will have to try, because net income approach I have already taught you. So maybe after the session you can try and share the answers with me. Let's start with the net operating income approach problems today. The first sum, firm L and firm U are identical in every respect, except that L is a levered firm and firm U is an unlevered firm. Firm L has 12% rupees 4 lakh debentures. Both the firms earn 20% on the total assets of rupees 8 lakh. Assume tax rate to be 50% and equity capitalization rate to be 15%. Compute the value of the firm and overall cost of capital using net operating income approach. So we are going to use the net operating income approach. Now, first they are asking you to find the value of the firm. So there are two formulas for value of the firm. Out of these two, which one to use? If there is no tax, we'll use the first formula, and if there is tax, we'll use the second formula. Let's look into the question whether there is tax rate. Just see here, they've given you the tax rate. Assume tax rate to be 50%. So when there is tax rate given, we are going to use the second formula. I'm writing it here. This or this, we are not using both the formulas. Now because tax rate is given, I'm using the second formula. So I'll copy the formula and we'll find the value of the firm. Okay, so value is equals to, first we'll find EBIT because EBIT is also not given in the problem. EBIT is equals to, see what they've told about EBIT. Both the firms earn 20% on total assets of rupees 8 lakh. So on 8 lakh, that is the total assets, they are earning 20%. So into 20 divided by 100, you will get your EBIT. $1,60,000. So we know the EBIT. Now we can find the value of the firm. Value is equals to EBIT 1,60,000 into 1 minus tax rate. So 1 minus the tax rate given here is 50%. So 0.5. Once we do this, we'll divide it by the cost of equity. Just see here, they've given you the cost of equity 15%. Equity capitalization rate. So I'll do it divided by 0.15. We'll solve this first fully. And then plus BP. What is B? Anybody? Huh?
Debt.
Debt. It is debt cost. So we have to take debt into tax rate. How much is the debt? Just see here, firm L has 12% rupees 4 lakh debentures. So we are going to take full 4 lakh debenture value into tax rate. How much is the tax rate? 0.5. Is that okay? Any doubts still here, anybody? I've put the values in the formula. Just check once if you have any doubts. Should we start solving?
Yes, sir.
Yes, ma'am.
So first what we will do is 1,60,000 into 1 minus 0.5. So that will come to 80,000 divided by 0.15. So first I multiplied it with tax rate. To this we have to plus 4 lakh into 0.5, which is 2 lakh. So V is equals to 80,000 divided by 0.15. You're getting 5,33,333 plus this 2 lakh, which is B into T. So what will be the value of the firm?
73,333.
7,33,333. Any doubts with the problem? Remember, first solve this EBIT into 1 minus tax. Then you divide it by cost of equity. You will get a value. To this, you have to add debt into tax rate. So 7,33,333 is the value of the firm. Is that clear?
Yes, ma'am.
Okay. Now
Yes,
we
ma'am.
have found the overall cost of capital. See here, they have said compute the value of the firm and overall cost of capital using net operating income approach. Now to find the overall cost of capital, I will use, okay, just a second. I had a formula in net increase. To find the overall cost of capital, we'll use this formula. So the formula says K naught is equals to Ki B by V plus Ke S by V. I'll tell you what is all that. K naught is nothing but weighted average cost of capital. Ki is nothing but cost of debt. Ke is cost of equity. Ki, instead of calling it cost of debt, we'll call it after tax cost of debt, because debt usually we take after tax. B is the value of debt. S is the value of equity. And V is the value of firm. Okay. Now, before we go into the formula or you by heart the formula, I don't know how many of you remember in FM I had taught you weighted average cost of capital using the tabular way. Do you remember it? Yes or no?
Yes, ma'am.
So what we took first, what we used to do, we used to take source. Remember equity, debt. So equity, debt. Suppose this was the source. Fine. Then what we used to take? Amount. How much of debt and equity? Then weightage. Correct? And then we used to take the cost of debt and equity. And finally, WACC. Remember all of you this? Same formula I'm using here. Just see. When I do B divided by V, I'll get the weightage. See here, I'm showing you, suppose equity is 10 and debt is 5. So total will be 15. So what is this 15? This 15 is V, value of the firm, because I'm adding both debt and equity. Okay, so if I want the weightage of debt, what I'll do? 5 divided by 15, correct? D by V, 5 by 15 if I do, I'll get the weightage. So that's what is taken here. This is the weightage of debt. If I want to find weightage of equity, what I'll do? I'll take equity divided by value. So E by V. Here equity is called as S. That's why it's taken as S by V. So these two are the weightages. And once we get the weightage, what we do? We multiply the weightage with the cost to find the WACC. So here Ki is the cost of debt. It is multiplied with the weightage of debt. Ke is the cost of equity. This is multiplied with the weightage of equity. When we add both, we'll get the weighted average cost of capital. Any doubts here?
No, ma'am.
Understood how the formula has come? This tabular is put into formula. This B by V, S by V is weightage, and Ki and Ke are the cost. So we multiply the weightage with the cost to get the WACC. Okay, I'm deleting this table just to explain you. I have just shown it. Let's put the values in the formula and find. Now the first thing that we have to see is we need cost of debt after tax. Because tax rate is given, it's important to take it after tax now. Just see what is the cost of debt. Firm L has 12%, 4 lakh debentures. So the cost of debt is 12%. But this is not after tax. They have just given you the cost of debt. So we are going to find KI is equals to after tax cost of debt. So how to find after tax cost of debt? Before tax it is 12%. If I want after tax, I should do 1 minus tax rate. Multiply 12% with 1 minus tax rate. If I do 1 minus tax rate, I'll get the after tax value. So 1 minus 0.5, 0.5 is the after tax value. When I multiply that with 12%, I'll get after tax cost of debt. Alright, so it will be 12% into 1 minus tax rate is 50%, so 0.5. So 12% into 1 minus 0.5, if I do, I'll get, anybody? 6%.
Yes, ma'am.
So after tax cost of debt is 6%. Now using this, we will put the values in the formula and we will find the overall cost of capital. So I want to find K naught. K naught is the weighted average cost is equals to KI, cost of debt after tax. So how much we are taking? 6%?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
6 into B divided by V. Now I know the value of the firm. Everybody, what is the value of the firm? 7,33,333.
333.
Yes. And what is the value of debt? It's given in the question. See, rupees, how much?
4 lakh.
4 lakh debentures. So 4 lakh is the
4
value
lakh.
of the debt. Yes. So B is 4 lakh debenture value divided by value of the firm. We calculated 7,33,333. So when I divide this, I'll get the weightage of debt. Let's go to equity now. Plus cost of equity. They've given you the equity capitalization rate. What is the equity capitalization rate? 15%. So we will take it as 15 into value of equity. S is nothing but value of equity. Agree all of you?
Yes, ma'am. Yes, ma'am.
Value of
Yes,
equity.
ma'am.
Huh. How to find value of equity? The second formula. I copied all the 3 formulas for you. The second formula, S is equals to V minus B, or you call it as E, equity is equals to V minus D. So what? Remember the preposition, it says value of equity is the residual value. From the total value, you find the debt value minus it, you will get the value of equity. So we'll solve it. S is equals to V. V is 7,33,333 minus B. B is nothing but the value of debt, which is given in the question, which is 4 lakh. So how much will be the value of equity?
3,33,333.
Yes. So we'll use that in the formula. We have found here S. You can see this is 3,33,333. And how we found total value minus debt value, we'll get the equity value. So equity is the residual, remainder value. So equity is 3,33,333 divided by V. Again, the total value 7,33,333. Solve this. 4 lakh divided by 7,33,333. You get the weightage as 0.54 into 6, which is the cost of debt. So it will be 3.27 plus. Now I'll do 3,33,333 divided by 7,33,333. I'll get the weightage of equity, which is 0.4545 into 15%. So into 15, if I do, the cost of equity or weighted average cost of equity will be 6.81. So plus 6.81. If I add both, I'll get the value of K naught. So 6.81 plus 3.27. How much you get? 10.08.
08.
So this is the weighted average cost of capital using net operating income approach. If they ask you to use net income approach, what formula we used? Anybody remembers? See here, we use this formula, no? V K naught is equals to EBIT minus divided by V. This was shortcut formula. We had EBIT value, we found value, V value, and we got it. But in case of net operating income approach, we cannot use that formula. We have to use this formula. So you'll have to remember this formula. Okay. Any doubts in the first problem? Using net operating income approach, we found the value of the firm and we found the weighted average cost of capital. So with this, you might have understood that the net operating income approach is based on formula method. There is no tabular way that we are going to use for it. To find the value, if tax is given, this formula. If tax is not given, we have this formula, EBIT upon K naught. Then to find the value of equity, we'll use S is equals to V minus B. And to find the cost of equity, if they don't give in the problem, we are going to use this formula. And to find the overall cost of capital, we'll use this. I'll write this also above.
Excuse me, ma'am.
Yeah, tell me.
Ma'am.
Yeah, tell me.
Ma'am, that 6 and 15 you have taken as it is. Why we have to not take it as percentage?
Okay, now if you don't take it as it is, no, if you take here 0.06 and 0.15, that is okay. Whatever answer you will get, no, you should do into 100.
Okay.
Okay, if you don't want to do into 100 later, then you can take it as full. Whatever answer you will get, it is directly in percentage.
Okay, ma'am.
Okay, in exam, if you take it as 0.06, 0.15, you will get the same answer. You will get 0.1008. So if you do into 100, it will become 10.08%.
Okay, ma'am.
Okay, when we were doing tabular method also, I had explained you take weightage in decimals and you take cost as it is. So final answer will directly come as percentage. So that's why the same logic I applied here. You can also put it in decimals, no problem.
Yes, ma'am. Thank you, ma'am.
Yeah. Any other doubts? Should we move to the next problem?
Yes, ma'am.
Okay, so let's do the 8th one. Firm L and firm U are identical in every respect except that firm L is levered firm and firm U is unlevered firm. Just a second. Just look at this sum. Is it complete? The previous sum that we solved, is it completed? Anybody? No, it is not completed because there are two firms and we have solved only once. Yes?
Yes, ma'am.
And we have solved for firm. Which firm I have solved for? Firm L or firm U?
Firm element.
Firm L, because I have used debenture. I have used debenture value and firm L has debentures. So whatever value I have found, that is for firm L. I have to do for U still. U doesn't borrow. So I have to find the value of U. Okay, so here, whatever value we have found out, I'll just write it here. Value for firm L, I'm writing in bracket L. So this is value of firm L. And here, this is cost of capital for firm L. Same way we have to do it for U. Just a second. Because tax rate is given, we are going to use this formula. So value for firm U is equals to EBIT. EBIT in the above formula we have found out. I'll take it as it is, which is 1,60,000. So EBIT 1,60,000 into 1 minus tax rate, so 1 minus 0.5 divided by KE, cost of equity given in the question is 0.15. So we'll solve this part. And then I have to do plus BT. What is B? What is B? Debt. Okay, now just see here in the question. Firm L and firm U are identical in every respect except that firm L is a levered firm. Levered firm means they will borrow. And firm U is an unlevered firm. Unlevered means that firm U is not having any debentures. It is not borrowing. Leverage means borrowing. So levered firm borrows. Unlevered firm means which is not borrowing. Okay. And if you see here also clearly, firm L has 12% rupees 4 lakh debentures. About firm U, they have not given debentures. So that means firm U has no debt. That means B is 0 into T, tax rate, which is 0.5. Anything multiplied with 0 will be 0. So therefore, that addition part will not come. 0 into 0.5 is 0. Okay. So value of U is equals to 1,60,000 into 1 minus 0.552, it will be 80,000, and 80,000 divided by 0.15, you will get 5,33,333 plus 0, because 0 into 0.5 is 0. So value of U is 5,33,333. Is that fine?
Yes, ma'am.
Let's find the overall cost of capital also. So this formula is what we'll use. K naught for firm U. Okay. First, what is given? KI. Is firm U borrowing?
No.
No, ma'am.
So there is no cost of debt. KI is 0 because the firm is not borrowing. When it is not borrowing, it will not pay any debt cost. Value of B is also 0 because it is not borrowing, divided by V, which is 5,33,333. Plus cost of equity is 0.15 into value of equity this is the formula for value. Value of equity S is equals to V minus B. V is 5,33,333 minus B is debt. How much is firm U borrowing?
0.
0.
Because it is not borrowing, it is an unlevered firm, so it is 0. So what will be the value of equity? 5,33,333. So here now we can put K is equals to S is 5,33,333 divided by V is 5,33,333 because total value of the firm is through equity. There are no borrowings. Okay, so I'll take 15 here, not taking the decimals. You want me to take the decimals and show? So 0 into anything, 0 into 0 divided by 5 lakh 33, but 0 multiplied with anything is 0. So there is no cost of debt, plus 5 lakh 33, 333 divided by 5 lakh 33, 333, it will be 1. Correct? 15 into 1 is
15.
15. So what is the overall cost of capital for you? 15%. Okay, I'll tell you a shortcut for this. When the firm doesn't borrow and it has only equity, whatever is the equity capitalization rate given in the problem will remain the cost of capital also, because there is only one source, equity. So weighted average cost will also be the same, because there is no weightage, full 100% is equity. So 100% equity into cost of equity, it will remain the same. But in exam, you just don't write like that. You need to solve like this and show it. So shortcut why I told you is you can cross check your answer. For unlevered firm, the cost, weighted average cost should be equal to the cost of equity, because there is no debt, no tax savings, 100% equity. So whatever is the equity cost, that only will be the overall cost for the firm. Any doubts with this sum?
No, ma'am.
No, ma'am.
In exam also, remember, if they give two firms, you have to solve for both the firms, L and U. Like I did only one sum and one part and was going to the next. That is not correct. Okay. So you have to be aware in the exam and understand that how many firms are given, what we have to do. Now let's go to the 8th problem. Firm L and firm U are identical in every respect except that I think it's the same sum, no?
Yes, ma'am.
It's the same sum, so let me just delete it. We'll go to the next one. Okay. Company A and Company B are in the same risk class and are identical in every respect, except that Company A uses debt while Company B does not. So see here, tell me which firm is levered, which is unlevered.
Ma'am, A is levered.
A is levered
Huh.
and B is not.
B is unlevered because
Unlevered.
B is using debt. A is using debt, so it is levered, and B is not using debt, so it is unlevered. So we have to calculate for both the firms. Okay, the levered firm has rupees 9 lakh debentures carrying 10% rate of interest. Both the firms earn 20% operating profit on their total assets of rupees 15 lakh. So this we will use to find EBIT. Assume perfect capital market, rational investors, and so on. A tax rate of 35% and a capitalization rate of 15% for an all equity company. So that 15% is equity capitalization rate, because that is for an all equity company, means it is for equity. Compute the value of the firm A and B using the net income approach and the net operating income approach. Also calculate the WACC. So we have to find using both the approaches. So it is like revising net income as well as doing net operating income, one more sum. So let's first do net income approach, because they've asked that first. I hope all of you remember how to solve net income approach problems. If not, we'll revise it now so you'll remember it. And in exam, they may ask you questions like this, asking you to solve for both the methods for 10 marks or a single method for 7 marks. Or maybe they can ask both the methods and put it like a case study. So 5 marks for net income, 5 marks for net operating income value, then 5 marks for cost of debt. Like this, they can have a combination. Okay. So let's start. Company A and Company B are identical. Let's call them as Company A and Company B. First, we need EBIT and what they have told about EBIT. Just see here, they have said both the firms earn 20% on the total asset of rupees 15 lakh. So on 15 lakh, 20% is the EBIT.
3 lakh.
So right here, 15 lakh into 20%, which comes to 3 lakh. Less interest, so we'll have to see which firm is borrowing and less the interest. So here they have said the levered firm has rupees 9 lakh debentures carrying 10% rate of interest, and which firm is borrowing? Firm A uses debt. So to remember this, firm A is borrowing, and how much it is borrowing? 9 lakh, 10% debentures. So on 9 lakh, 10% is the interest rate. So 10% of 9 lakh will be 90,000. And here firm B is not borrowing, so the interest on that will be nil. Fine. Now they have given the tax rate, so first we'll find EBT. 3 lakh minus 90,000 is 2 lakh 10,000, and 3 lakh minus 0 is 3 lakh. So this is earning before tax. See what is the tax rate given. They've given a tax rate of 35%. So we're going to use that. So here the tax rate is 35%. 35% on the earning before tax. So on 2 lakh 10,000, 35% we have to find. 73,500. And on 3 lakh, 35% is 1 lakh 5,000. Once we minus this, we get the net income, or we also call it as earning after tax. So that is 1 lakh 36,500, and 3 lakh minus 1 lakh 5,000, it is 1 lakh 95,000. So this is the net income. Now we can find the market value of debt and market value of equity. And then we can add both to find the total value of the firm using net income approach. So to find the market value of debt, the formula is interest divided by cost of debt. So it is only for firm A because only A is borrowing. So 90,000 is the interest divided by cost of debt is 10%, which is given in the problem. So 90,000 into 0.1, the value of the debt will be 9 lakh. Whereas in case of firm B, it is nil because firm B is not borrowing. So we are not finding the value of debt. Now let's find the value of equity. The formula is net income divided by KE, which is nothing but cost of equity. So first we'll do it for firm A. The net income of firm A is 1,36,500 divided by cost of equity. It's given in the problem here. Equity capitalization rate is 15%. So we are going to use 0.15. The rate 1,36,500 divided by 0.15. You will get the value as 9,10,000. And we'll do it for firm B now. The net income is 1,95,000 divided by the cost of equity 0.15. When you divide it, you will get the value of equity, which is 13 lakhs. How to find the value of the firm? You need to add both market value of debt and market value of equity. So once we add both, which is here 9 lakh plus 9 lakh 10,000, which comes to 18 lakh 10,000, and 0 plus 13 lakh, it is 13 lakh. So this is the value of firm A, 18 lakh 10,000, and firm B 13 lakh. They've also asked you to calculate the overall cost of capital. So the formula, the shortcut which we have, K naught is equals to EBIT divided by V. So let's do it for firm A. The EBIT is 3 lakh divided by V. For firm A, the value is 18 lakh 10,000. into 100 you do 3 lakh divided by 18 lakh 10,000 into 100, 16.57%. And similarly, we'll do it for firm B. The EBIT is 3 lakh divided by 13 lakh into 100,
23.07.
23.07%. So this is net income approach. I have done around 5 sums on this. 6th one I've asked you to do. This is one more. So you can consider it as 7th problem. We've revised the approach. Now that we have finished net income approach, the first part, using the net income approach, we have found the value of the firm as well as we've calculated the weighted average. Now let's do it using the net operating income approach. Now first is which formula to use. So for that we have to see if tax rate is given. So yes, there is a tax rate given, and if tax rate is given, we'll use which formula? The one with the tax. That means the second formula. The first one only if tax rate is not given. Because the tax rate is given, we are using this formula. So we copy the formula. And right here, net operating income approach. And we put the formula, and above was net income approach. Let's mention that. Okay. So in this formula, we have to go on putting the values now. So V is equals to EBIT, we have already found out for net income approach 15 lakh 20%, which is 3 lakhs into 1 minus tax rate. So 1 minus the tax rate is 0.35, which is given in the question, divided by KE. KE is the equity capitalization rate, which is 15%, so 0.15. Once we solve this, we will add plus BT. So B is the value of debt. So we are doing this for which firm? A, because we are considering debt here. So we're doing it for A. So for firm A, the value of debt is 9 lakh. So we have to take that 9 lakh here into tax rate. So tax rate is 0.35. BP, B into T is what we have to do. So let's solve it further. So value for firm A is equal to first 3 lakh into 1 minus 0.35.
One lakh 95,000.
1,95,000 divided by 0.115.
1 lakh
13 lakhs.
13 lakhs. 13 lakhs plus 9 lakh into 0.35. 3 lakh.
3,15,000.
So value of A is equals to 16 lakh.
16 lakh 15,000.
Okay, so this is the value of firm A. Just see here, using net income approach, we had got it as 18 lakh 10,000. But using net operating income approach, we are getting it as 16 lakh 15,000. Both the approaches are different because in case of net income approach, how we found the value? We used market value of debt and equity. So we consider them separate. Debt is separate, equity is separate, and then we add. But in case of net operating income approach, we take EBIT as a whole and find the value. So full profit we're taking, so full value we get. Similarly, we'll do value for firm B. EBIT is 3 lakh into 1 minus tax rate divided by KE, which is 0.15, plus BT. What is B here now?
0.
0, because firm B doesn't borrow. When firm B doesn't borrow, it is 0 into tax rate, which is 0.35. So only the first part will give you the value. 3 lakh into 1 minus tax rate divided by 0.15, you will get 13 lakh plus 0. So value of B is equals to 13 lakhs. Is that clear?
Yes, ma'am.
Now we'll find the weighted average cost of capital. To find the weighted average cost of capital, we'll use this formula. And we'll also use the formula to find the value of equity, which is S is equals to V minus P. Yes. First we will do S is equals to V minus P. So S is nothing but the value of equity. So I'm doing it for A first. Firm A. Value of firm A is how much? As per net operating income approach, it is 16 lakh 15,000. So 16 lakh 15,000 minus the value of debt, that is B. In the question, we'll see how much is the debt given. The levered firm has rupees 9 lakh debentures. So from 16 lakh 15,000, 9 lakh is debt. So how much will be the equity? 7,15,000. Now same will do value of equity for firm B. So value of firm B is 13 lakhs. Minus value of debt for firm B is how much?
0.
0. Because firm B doesn't borrow. When it doesn't borrow, the value is 0. So 13 lakh minus 0 is 13 lakh. So this is the value of equity for firm B. Now we have value of equity for both the firms. One more step I have to do. Can anybody tell me? Cost of debt, what I should do?
Ma'am, 1 minus T.
Yeah, we should take it after tax. So I have to do 1 minus tax rate. Correct? In the previous sum also I did it. 12 into 1 minus 0.5 and we took 6%. Remember? So let's do after tax
Yes,
cost
ma'am.
of debt. The cost of debt is given in the problem and that is 10% and the tax rate is 35%. So what we have to do? 10% into 1 minus tax rate. So 1 minus 0.35. So if I do 10% into 1 minus 0.35, after tax cost of debt will be 6.5%. Okay. Now we can put it in the main formula and find the cost of capital. And we'll do it first for firm A. K0, I'm doing it for firm A. Is equals to KI, that is cost of debt. I should take after tax cost of debt. So how much I should be taking? 6.5 into value of debt. How much is the value of debt given in the problem? 9 lakh, correct? Divided by value of the firm. Value of the firm for A is 16 lakh 15,000. So divided by 16 lakh 15,000. plus cost of equity. The equity capitalization rate is 15% into value of equity. We just found out here value of equity for A is 7,15,000. So I'll take that 7,15,000 divided by total value of the firm for A is 16,15,000. So let's solve and find. Are you getting it as 10.26%?
Yes, ma'am.
Yes?
Yes, ma'am.
Okay.
Yes, ma'am.
Ma'am, 10.215.
No, ma'am, 10.26.
It depends on the decimals also. 10.2 till that also, if it is correct, it's okay. Little bit here and there, if you have taken 4 digits or all the digits or only 2 digits, depending on that, it will differ a little bit. But if it is 10.2, it is okay. So everybody getting till here?
Yes, ma'am.
Now let's do K naught for B. Can anybody tell me before solving what will be the answer?
13 lakhs.
No, I want cost of capital
Oh, 15.
15% because it's only
Ma'am, 15%.
B is only equity. So whatever is the equity cost will be the overall cost. So it will be 15%. Now let's see. We'll put in the formula and see. First is KI. KI is 0.
Ma'am, 15%.
Correct. Cost of debt is 0 because this firm is not borrowing. Value of B is 0 divided by value of the firm is 13 lakh plus cost of equity is 15%. Value of equity is 13 lakh full because there is no debt divided by value of the firm is 13 lakh. So if you solve it, 13 lakh divided by 13 lakh is 1. 15 into 1 is 15. So K naught for B will be 15%. Are you understanding the problems? Any doubts?
No, ma'am. It's clear.
I have done 2 sums by now. We'll do some more, but before I go to the next sum, that is the 9th, 10th, and then we'll go to the next method also. I want to give you the difference between the net income and the net operating income approach. And now I want you to tell me what are the differences. So what we will do is we will make a particular we'll make a table here only and we'll find the difference. So maybe after that, before the net operating income approach problems, we'll do that. Difference between net income and net operating income approach. This is not there in my slides, but this can be a 7-mark question, a 10-mark question, or sometimes a 3-mark question. So it's very important for you to know the difference because it is given by the same author, but the theories are totally opposite. So what are the differences and how they are opposite, we'll have to understand. Here under net income. Can anybody tell me the first difference? What net income approach tries to say? Capital structure is what? Relevant or irrelevant?
Ma'am, relevant.
Relevant to the value of the firm. So if you change the capital structure, the value of the firm will change. The net income approach is trying to say this. What is net operating income approach trying to say?
It is totally irrelevant, ma'am.
It is irrelevant. So it is irrelevant. So whatever you do with the capital structure doesn't matter. Your value of the firm will remain same. So it is irrelevant. Okay, that was the first difference. Anybody? Second difference?
Tax assumptions, ma'am.
Tax assumption, no, it's same for both because he assumed tax and later he removed. So that we will not consider here. Anything else?
Ma'am, borrowings.
What in borrowings?
Borrowings will affect the value of firm in net income approach. And in net operating, they will not affect.
Okay, we can write that, but that's what the first thing also means, but I'll still write it. Debt. Instead of borrowings, I'm using the word debt. Debt has an impact on value of the firm. And here we'll say it has no impact. Whether you borrow or don't borrow, it doesn't matter. Value of the firm, there's no impact. Debt has no impact. Okay. Anything else? Okay, tell me how to find value of the firm using net income approach. Just now we did a sum, no? With both the
Market
approaches.
value of debt plus market value.
Market value of debt plus market value of equity.
And how to find it using net operating income approach.
PBIT into 1 minus T.
Two formulas, right? These two formulas.
Yes, ma'am.
Tax is given if it is not given. So is this also a difference or no?
Yes, ma'am.
Yes, both the formulas are different. So the way or the method of calculating equity is different. Okay, then remember the assumptions. What net income approach said? Cost of equity and cost of debt are constant. Remember? And net operating income approach said cost of debt and overall cost. That means weighted average cost are constant. Yes or no?
Yes, ma'am.
So here the difference is he is telling equity is constant, he is telling no, equity is not constant, overall cost is constant. Okay, then another one you can write here, cost of equity is constant, whereas net operating income approach says cost of equity will increase with the increase in debt, because when we borrow more and more, risk increases. When risk increases, equity shareholders start demanding for more capital. So this is another difference. Any other? Remember about the cost of debt, explicit, implicit cost. In net income approach, he didn't say anything such. So cost of debt has only explicit cost because he didn't mention about implicit cost. But what he did in net operating income approach, he said there are two costs for cost of debt. So cost of debt has explicit and implicit cost. Yes or no? You will understand the difference only when you have understood both the theories and you've heard them. So when you read both the theories and then you look at the difference, it will start making sense. And if you have understood both the theories, in the exam you can only read the difference and go. And if they ask you to write any one theory, you will be easily able to write it. So you will have to the graphs. I don't know if I'll be able to copy it. I'm trying. Or else what I'll do is I'll take a screenshot and paste it. Both the graphs are different from each other. So in the exam, you can show both the graphs. So this is the graph for net income approach, whereas for net operating income approach, okay. So this is for net operating income approach. So you'll have to draw both the graphs and show it in exam. Next, any other difference? How many we finished? 7 we are done with. 7 for 7 marks if it comes. 7 differences are more than enough. But if you know any other, what he said here, overall cost, look at the graph, overall cost will decrease. Decrease as you increase the borrowings. Whereas here he says overall cost will be constant. K naught you see there in the graph, he has kept it constant. Okay, so I have given you around 8 differences. You can see if you find some more, if you read the theories again and again, and you may identify a few differences. If you find any, you can write those also. Okay, so 7 mark, 10 mark or 3 mark it may come. If it comes for 3 marks, any 3 differences, 7 marks you can write 7, and for 10 marks maybe you can write these 8, and if you can find some more, you can mention those also. Was the difference part clear? Any doubts?
It's clear, ma'am.
So you have to read both the theories also properly. Should we do one more sum?